The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning, Middle Georgia, and it's great to be back with you.
Good morning. Good morning, everyone.
You know, this weather is about to get old already, isn't it? You know,
yeah.
2 days of extreme cold.
If it's going to be this cold, at least snow.
Exactly. Well, they said that's going to happen Sunday.
Right. So, but it needs to snow like it did last year, where it was thick enough we could go sledding.
Yeah.
We had a couple days off school and work. It was, you know.
They're thinking it might be ice. So
that's not fun.
You can sled on ice.
I guess so.
Yeah.
In your car.
Well, don't get out and drive unless you have to.
Right.
And, you know, don't buy all the bread and the milk because the ice will be gone in 2 days.
Yeah, so. Max.
Yep. All right. Moving into the show, inflation eased in December as the core consumer prices rose at the slowest annual rate since March of 2021 in the final months of the year. The Consumer Price Index, or the CPI, released by the Bureau of Labor Statistics Tuesday morning, showed that on the core basis, which excludes the more volatile categories of food and energy, the consumer prices rose 0.2% over last month and 2.6 over last year. The 2.6 increase in the core CPI matches the rise reported in November and equals the slowest pace of the annual inflation since 2021. That's a March of 2021. The total inflation within the economy rose 0.3% over the prior month and 2.7% over the prior year. And this is in line with the economists' expectations. Inflation has remained stubbornly above the Federal Reserve's 2% target for some time, but has begun to drift downwards over the past year. However, and it's been characterized by policymakers as a less accurate risk of the economy than a dramatic softening of the labor market. So,
the downside surprise to core prices in December occurred despite some payback in certain items following their suspiciously weak price moves over October and November, suggesting that underlying inflation pressures have genuinely moderated in recent months. Tuesday's report comes just a few days after the December jobs report showed the unemployment rate retreated from a 4-year high, largely firming up investor bets that the Federal Reserve will keep rates unchanged later this month. The odds on whether the Fed will cut rates later this month is 5%. The details of Tuesday's report showed inflation pressures on household food budget remains notable, with the index for food rising 0.7% in December and outpacing the overall price increases. The BLS noted that 5 of the 6 major grocery store food groups, which includes grains, meat, dairy, fruit, drinks, and other food at home, saw prices rise on a monthly basis in December. Only the cost of meat, which includes fish, eggs, and poultry, fell in December. Helping push core consumer prices lower was a drop in the price of used cars and trucks, with the index falling 1.7% in December. And Sherry was going to joke that was good news for me if she were here today, but
yep.
I'm hoping to be done buying used cars for a very long time.
I know you are.
Yes,
so,
amen.
But you've gotten very good at it.
I've gotten good at it, unfortunately.
Airline fares also fell 0.5%, with the overall transportation service category also falling 0.5% last month. The rise in headline prices was tempered by energy costs, with the price of gas falling 5.3% in December amid a broader decline in oil prices. The energy index fell 2% from the prior month in December.
Yep, and mortgage rates fell to their lowest level in more than 3 years this week after President Trump announced that Fannie and Freddie Mac would buy $200 billion of mortgage bonds. The average 30-year mortgage rate was 6.06 through Wednesday, down from 6.16 just a week ago. And that's the lowest level since September of 2022, when mortgage rates initially broke 6% following a prolonged period of ultra-low rates. The average 15-year mortgage rate, meanwhile, dropped to 5.38% from 5.46. Looking better every day.
For whatever it's worth, I mentioned a few weeks ago that I have a client who's in the mortgage industry, underwrites, I believe, for mortgages here in Warner Robins. And I was having a conversation with him a few weeks ago, and he said after years and years of doing this that he feels like that 5% is a good balanced rate for mortgages. 3 was too low.
Yep.
3, 4, 2.5. Those were too low. 7's too high. 8's too high. He feels like 5 is a good.
But I have read in the last couple of months, though, that historically the average for mortgage rates sits right at 6%.
Okay. That doesn't surprise me. Right.
Yeah. So
it's just that houses didn't used to be so unaffordable with the 6 or 7.
That's right.
So now he feels like the good equilibrium is a 5, where with the housing prices where they are, that people are going to at least relatively be able to afford homes again.
I hope so.
Yeah.
Now, how to open a Trump account in 2026. Here's how the election works, who qualifies, and what happens next. The tax season is approaching, and for parents of minor children, there's a new form worth paying attention to. The IRS has finally released Form 4547, which allows taxpayers to register an eligible child for a Trump account while filing their 2025 tax return, even though they won't be able to contribute money until later in 2026. Here's what you need to know. You'll make an election using Form 4547, which is available on the IRS website. The form is a single page but serves 2 distinct functions. First, it allows for an authorized individual to elect to open an initial Trump account for a qualifying child. Second, it provides a separate election to request the $1,000 from the federal government as part of the pilot program. The second part is extremely important. If a taxpayer wants the pilot contribution, they must affirmatively request it by checking the appropriate box. Simply opening the account does not trigger the $1,000 deposit, so that is a critical step to ensure you get the $1,000 seed money.
One practical detail parents may appreciate is that the IRS Form 4547 allows elections for up to 2 children on a single form. Taxpayers with more than 2 qualifying children can file additional forms as needed.
And for you, Jonathan, that's a big deal.
Well, I actually, as I read through this article this week, I do only have 2 qualifying kids because I only have 2 that are under 10. And so it was saying you can retroactively do it. I think, if we'll read on here, but I think
what I got out of this article is that people older than 10 can qualify.
Oh, well, if that's
especially
the case.
for the Bill and Melinda Gates money.
Okay. Well, the seed money, the 6.25. So I think we may have information on that here. Hopefully that's the case. But Form 4547 also introduces the concept of a, quote, responsible party. This is a contact person who will work with the Treasury to establish and administer the account.
Right. And taxpayers can file the Form 4547 with their 2025 return, either on paper or electronically. The instructions also note that Form 4547 may be filed after the tax season, including through an online portal once it becomes available. After the election is processed, the Treasury will take steps to establish the account, including sending an activation instruction to the responsible party. That activation process is expected to begin in May of 2026 and will include identity verification. And this is important. Until the identity verification is complete, the account is not fully operational. What won't happen anytime soon is the funding. No contributions of any kind from the parents, the employers, or the government will be made before July 4th, 2026. And that includes the $1,000 pilot contribution.
Right. So who can open an account? The instructions draw an important distinction between simply opening an account and requesting that pilot contribution that Randy's talking about. If a taxpayer elects to open only an initial Trump account, the IRS establishes a priority order for who qualifies as an authorized individual. First, a legal guardian, then a parent, followed by an adult sibling, and finally a grandparent. However, if the taxpayer is also requesting the $1,000 pilot contribution, the rules are more restrictive. In that case, the authorized individual must anticipate that the child will be their qualifying child for the applicable tax year. This creates an important nuance for families. A taxpayer does not need to have already claimed the child as a dependent on the 2025 return in order to file a Form 4547. But checking that box implies a representation about what's likely to happen. For that reason, the instructions emphasize that taxpayers requesting the pilot contribution should be confident they meet the qualifying child rules for the year of the election. If you're filling out the form now, that's 2026. The IRS also provides some flexibility, noting that an election may remain valid even if qualifying child status changes later, provided other requirements are met. Still, taxpayers requesting the pilot contribution should pay close attention to the rules.
So what are the contribution limits and withdrawals? The Trump account comes with a $5,000 annual contribution limit adjusted for inflation after 2027, but that limit does not apply to all contributions. The $5,000 cap includes contributions made by employers under a special employer program and to contributions made by individuals such as parents or grandparents. Employer contributions, which are included in the $5,000 cap, can't exceed $2,500 per year. The good part, they are excluded from taxable income.
Yep. Other contributions fall outside the $5,000 cap. These include the $1,000 pilot program contribution and qualified general contributions made by the government or charities and certain rollover contributions. Those amounts do not reduce the $5,000 annual limit available for families or employer contributions. Some contributions, including the federal pilot contribution, qualified general contributions, and employer contributions, do not create a basis in a Trump account. By contrast, contributions made by parents, grandparents, or others with after-tax dollars do create a basis. And you can think of the basis as your cost basis, like in a stock. And in this context, it applies to the money that has already been taxed, like gifts from parents and grandparents and so forth, that shouldn't be taxed again.
Yeah. Here's why that matters. After the beneficiary turns 18, withdrawals from a Trump account will generally be taxed like distributions from a non-deductible traditional IRA, which means that part of the distribution may be taxable and part may be tax-free, which is the return of your basis that Randy is talking about. That prevents after-tax contributions from being taxed twice. And the IRS has made clear that basis must be tracked, something that will require very careful record keeping, particularly for accounts funded by multiple sources, like parents, grandparents, etc. Until then, Trump accounts are tightly restricted. Because they're intended as long-term savings plans, distributions are generally prohibited while the beneficiary is under 18.
The only permitted withdrawals during this period, before the child turns 18, are limited to specific circumstances, such as rolling the account into another Trump account, correcting excess contributions, or distributing the account upon the beneficiary's death. The instructions also allow certain qualified rollovers, including limited rollovers to able accounts once the beneficiary turns age 17.
And you know what's interesting is that the hardship withdrawals are not permitted, and you can't simply close the account and distribute the money because your circumstances have changed.
However, once the beneficiary does turn 18, most of the restrictions fall away and the account begins to operate like a traditional IRA.
Yep. And the Trump accounts are subject to a significant investment restriction, and that's been one of the main criticisms of the plan. Eligible investments must track U.S. stock indexes, carry no leverage, and have annual fees capped at 0.1%. IRS guidance also requires trustees to maintain procedures for monitoring compliance, including the use of default investment options. If an investment becomes ineligible because of the fees increases, for example, corrective action is required. Cash and money market funds are generally prohibited except in limited circumstances. Now, if you're ready to get started and you're planning on filing the Form 4547 with your 2025 tax returns, the instructions suggest you make sure you can answer yes to these following 4 questions. The first one is the child is under 18 years of age at the end of the election year and has a valid Social Security number. Next is you qualify as an authorized individual. And if requesting the pilot contribution, you expect the child to be your qualifying child in that same time frame. And the third is you understand that no contributions can be made before July 4th, 2026. And lastly, you are prepared to complete an account activation process in 2026, including the identity verification, which is essential.
Wait, so what about that extra seed money that Randy mentioned earlier? It's Michael and Susan Dell, although Bill and Melinda Gates should also contribute. They should too. They got enough money.
I was thinking it was the Gates.
I wish it was. They should add on. They should pile it on. But anyway, Michael and Susan Dell pledged $6.25 billion to seed Trump accounts with $250 each for roughly 25 million children under the age of 10 who were born before 2025. There's where I read that part. So I only have 2. I wish all 4 were. And thus are not born before 2025 and thus aren't eligible for the $1,000 pilot program. If not enough families of children under 10 open accounts, the remaining from the $6.25 billion could be allocated to older children. So maybe enough won't do it.
That's
And
where I was getting at.
I got you.
Yeah.
So I discourage everybody from doing it, so all 4 of mine can. To be
selfish there.
Yeah, it's all about me. To be eligible, children must live in zip codes where the median household income is below $150,000. That's going to limit people. What's next for taxpayers? With Form 4547 now available, parents can open a Trump account as soon as this tax season, as we've been discussing, even though funds won't be available just yet. If you're considering participating, watch for final Treasury and IRS rules.
Yep. This is a good program. I'm glad to see it
I
because
agree.
a lot of folks need that little extra boost to get an IRA started, start saving early. I think it's a good shift in the mentality of Americans.
For sure. And even if a family only ever puts the pilot money in,
Yeah.
when the child is 18 or let alone 30, 40, 50, 65, that's going to be something.
And you know, we talked about this several months ago. If a parent puts a program like this in place when the child is born, by the time they're 18, there's like $15,000 in that account. So
Right.
it's great. All right. So what's the best investment advice you've ever received? And if you want to share with me on the next show, email me at randy@rfmoney.com. To me, it sounds like fun. All right. So Sherry is not here today, but she said, I asked her the question, and she said she got her first job as a dishwasher at age 15, and her dad took her to the bank and opened an account. And he had to, and she had to deposit a certain amount of what was made every payday, and it became a habit for her. And because he wouldn't want me to, he would only want her to buy shoes. He would only buy her shoes and underwear, and then that's how it made her become a serious bargain shopper. And both of these habits have helped her over the years. It made her a saver and not a spender. And her dad never invested in the market, so they never really talked about it. And once she graduated from college and got a real job, she was introduced to a company 401k plan, which she signed up for. And every time she got a raise, she increased the percentage of what went into the account, and this became a habit. So,
Yep. And for me, on that same note, I was given this advice: contribute 15% to your 401k. When I first started working straight out of college, like most people, I was completely unaware of how to properly save for retirement. And my boss at the time had previously worked in the financial services industry, and he said to me, save 15%. Why wouldn't you? You're 22 years old. You haven't gotten used to having a real paycheck yet. You might as well save as much as you can now and get used to the take-home paycheck right out of the gate. So I took his advice. I saved 15% for several years and never knew any different, and that helped us a lot.
The advice that I was given was how much you keep is more important than how much you make. At the end of the day, what you're left with is really what matters, especially if you are renting, because if you're paying a mortgage, at least I can see the argument where you're building some sort of equity in your home. But if you're renting, that money is out the door, it's gone. It's just really, it really is about what you keep at the end of the day.
amen. All right. And for me, it's simple. Spend less than you earn and start saving at an early age to make it a habit, like Sherry was talking about earlier, and Jonathan. This seems like simple advice, and it is. But there are so many that live paycheck to paycheck because they are just buried in debt. And I wish people would just quit doing the YOLO thing, living for today and spending every dime that comes into their
a problem.
Their pocket. So anyway,
All right, so in case you did not see this article, a family dog rescued after chewing battery-powered heated glove, sparking house fire. This is an uplifting one. Firefighters rescued a dog from a burning home in Canada last Saturday morning after the family pet accidentally started a fire by chewing on a battery-powered glove. Ottawa Fire Services said crews were dispatched just after 9 a.m. to a home after a monitoring company reported an active fire alarm. The homeowner, who was on the way to the house, confirmed through interior security cameras that a fire was burning inside. Several passing motorists also called 911 to report flames visible in the residence. Firefighters arrived within 4 minutes and found heavy smoke and flames venting from the first floor bay window, and crews launched an aggressive attack. Fire officials said the dog had chewed on a heated skiing glove containing lithium-ion battery. Of course, it's always the lithium-ion batteries, which sparked the fire. Firefighters searched the house and found the dog and carried it safely outside. The pet was not injured, which is amazing, and no people were inside at the time of the fire. Security camera footage showed that the dog pulled on the glove, pulled it onto the couch, damaging the battery, which then ignited. Fire officials warn that lithium-ion batteries can pose serious fire risks if damaged, and urged residents to store battery-powered items safely and keep them away from pets and kids. I recommend you Google how to safely store lithium batteries just to better educate yourself. And Randy, you have a funny story from a year or so ago.
Oh, it's not funny.
Not funny.
Yeah, our automotive garage created about $100,000 worth of damage off of one little battery
That was thrown in a trash can.
And
By a customer, right?
no, it was actually by one of our mechanics.
Okay.
The customer service person. And it was just a tiny little battery. I mean, it was one that goes in the fob of your keys.
Innocent enough mistake.
Innocent enough. Anyway, these batteries, even the small ones like I was just talking about, can cause a fire. And, you know, the damage that one little battery can have is just huge.
And damage aside, like injuries.
Yeah.
You know?
Well, in this case, luckily the dog lived.
Right. And in your case, nobody was hurt because
Yeah.
it was overnight, right? That it happened?
It happened overnight. The cool thing about it in our case was that it was such an intense flame. It generated so much smoke that it put the fire out before we had more smoke damage than we did fire damage.
Oh, yeah.
So, but did they rename the dog to Sparky? Dum-dum.
There you go. All right. So a new year checkup for life insurance planning. As 2026 begins, it's an ideal time for people to review and possibly reassess their life insurance needs within the context of the broader financial picture. Major life events such as marriage, birth of a child, buying a home, relocating, or entering new business arrangements can materially change the amount of financial protection that a family requires. Life insurance at its core is about creating liquidity at death. So reviewing assets, liabilities, future obligations, all essential to determining whether existing coverage still aligns with those needs. Experts emphasize working with trusted professionals, financial planners, insurance agents, CPAs, attorneys, especially those already familiar with your financial situation. For individuals without coverage, decisions around timing are less about age and more about responsibility, such as supporting a spouse or planning for future dependents.
Yeah, and I'll use our situation as an example of why this is important. And when we moved to Warner Robins, Sherry was self-employed, and we had 2 kids in school, and I had taken a job on the base, and I had several years before I could retire. And Sherry wasn't making much money as an insurance agent then, as she was just getting started with her career with Rosenberg. So she took out $1 million policy on me just in case something did happen to me. And that would have left Sherry with a mortgage and a couple of kids and not a lot of savings. So we didn't need to use the policy, thankfully, but it did give her peace of mind knowing that that she would be okay if something did happen to me. And you may want to talk to your adult kids about this because they may not be thinking insurance at a younger age, but it really is important.
Right.
So
For sure. Right. Well, they need to at least be aware of it.
They do.
That the coverage is there, and that if something, God forbid, does happen, that there is some help on the way.
And I think people have a general misconception that all life insurance is prohibitively expensive.
Not the case.
Not the case. So
Not the case. We're looking this week alone. We have a client that needed some, and she's in her 40s. And I think for her to get, she doesn't have a ton of need, but $200,000 of coverage for her for a 30-year term was like, I think it was $40 a month or something like that. So it does not have to be cost prohibitive at all, and it's a responsible thing to do in a lot of situations.
Agreed. All right, a classic investment strategy that has fallen out of favor is starting to stir some interest. The traditional 60-40 portfolio that has a 60% allocation to stocks and 40% to bonds has become less popular with retail investors after years of near zero interest rates and made fixed income less compelling. Investors especially soured on the 60-40 portfolio in 2022 after the simultaneous fall in both the stock and the bond market. That fall eroded trust in what was supposed to be an uncorrelated balanced strategy that gives investors an ideal blend of growth and risk mitigation. But now some expect that it could be time to reassess the strategy. In 2025, the iShares Core U.S. Aggregate Bond, or AGG, had a total return of 7.2%, its best performance going back to 2020. The results showed that investors that in fixed income portions of their portfolios could start to play offense in addition to playing defense. Phil Blancato, the chief marketing strategist at Osaic, and that's our broker-dealer, says that he thinks sometimes people forget the opportunity that presents itself in the fixed income space when the Fed goes through prolonged rate-cutting cycles. He argues that the old 60-40 portfolio looks kind of sexy again because of what the bonds can deliver.
Yep, the 2026 outlook is fairly compelling for bonds, actually. A monetary easing cycle would lift bond prices. Further, the vulnerability in the stock market due to higher valuations and fears of an artificial intelligence bubble would mean that fixed income can play defense in a portfolio. Blancato believes investors can do really well by keeping it simple, sticking to bond market proxies such as the AGG ETF. He suggested going out 6 or 7 years in duration. Duration is a measurement of bond prices' sensitivity to rate fluctuations, and issues with longer maturities tend to have greater duration. When the 60-40 worked for so long, there's this opportunity to be in that portfolio, get great return, and by the same token, not have to take a lot of extra risk to do it, according to Blancato.
To be sure, others expect there's a case for other assets in the 40% allocation. Some say there's an argument for alternatives like private credit, as well as for commodities such as gold. This would be in addition to government and corporate bonds. In 2026, metals have surged to start the year, with gold, silver, and copper all rallying.
Yep, to really great heights.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
The rule of $1,000 saving guideline states that for every $1,000 of monthly income you want to generate in your golden years, you'll need to have $240,000 saved in your retirement account. That assumes a 5% annual withdrawal rate and a 5% annual return. Before you retire, track your spending on a piece of paper for 30 days to see where your money is going. Are there any expenses that will go away when you retire? Are there any expenses that will actually increase? Do you know if there will be expenses that replace other expenses after retirement? Say because of a new hobby or an additional travel. This will give you peace of mind knowing that the amount of money coming in each month can cover everything. Next, look at your future source of income. This could be Social Security, a work pension, or alternatively an annuity or maybe even rental income that you might see.
All right, let's assume you need more cash than, say, $4,000 a month to fund your retirement lifestyle. The new number would then be $960,000. And talk with your financial advisor about your risk tolerance and how much of this money will be in the market and what precautions they will take to protect your investments in a market downturn. Like most simplistic retirement guesstimates, personal finance pros say there are drawbacks. The rule of 1,000 doesn't account for all unknown variables that will impact savings and spending over one's lifetime. For example, we hear from a lot of our clients that their insurance premiums are going through the roof and it's really cut into their spending plan. One of the downsides to the rule of 1,000 is the 5% withdrawal rate, which errs on the aggressive side. A popular retirement strategy, for instance, is the 4% rule. The simple rule of thumb calls for just 4% of savings to be withdrawn in the first year of retirement and then withdrawing the same amount plus adjustments for inflation in the following years. This strategy is designed to provide withdrawals for 30 years without depleting the saver's nest egg. And we prefer the 4% rule. And when we went through the last massive downturn of 50% in 2008 and 2009 due to the housing crisis, we had to move the fee portfolios to all cash. Our clients who were only taking 4% were back to even in 2009, and those taking out more were not. We were in cash only for about a year, and we were able to get back in the market when it started recovering.
And there's no guarantee that more aggressive investments will return 5% per year either. In fact, in July, Vanguard rolled out its last 10-year annualized return projections, which showed U.S. stocks posting average annual returns of just 3.3% to 5.3%. The key takeaway, drawing down 5% could put retirees at a greater risk of running out of money. The Vanguard article I referenced was written in July of 2025.
The $1,000 a month rule doesn't specify a timeline for how long the lump sum will last, but rather on a savings target. If the $240,000 needed to generate the $1,000 in monthly income doesn't deliver a return, for example, the money would last only 20 years. What's more, the simplistic rule of $1,000 doesn't take inflation into account, which is a big deal. Look at how much car and homeowner insurance has increased in the past 2 years. And another factor is if the $240,000 is sitting in a traditional 401k or IRA, withdrawals will be taxed at the retiree's regular income tax rate. That means the $1,000 you withdraw might only net $780 in spending power if you're in the 22% bracket, or $880 if you're in the 12% bracket.
Those are good points. Basically, the rule of 1,000 isn't the only rule that provides ballpark projections of how much you will need to save to boost your retirement security. Here are other ways to estimate how big a nest egg you'll actually need. There's also the 70% rule. This rule says your retirement spending will be 70% of your pre-retirement post-tax income, according to Experian. For example, if your after-tax income is $100,000, your estimated retirement spending will be $70,000 per year, or $5,833 per month.
Yep. And then there's the rule of 120. This rule is a take on the old 100 minus your age technique to get to the proper stock allocation in your portfolio. The rule of 120, however, says subtract your age from 120 to calculate how much of your 401k should be in stocks. For example, if you're 65 years old, you would subtract 65 from 120, and then your new stock portfolio weighting would be 55%. A 40-year-old would have an 80% retirement plan in stocks. This rule, while providing some guidance, has weaknesses too. What it doesn't do is to tailor the plan to reflect the real spending needs of retirees.
Yep, and it also may underestimate how long retirement dollars must last given increased longevity, potentially creating an asset mix that lacks enough growth to ensure a retiree won't outlive their money. You must consider that our money needs to last 20 to 30 years. So, say you're late to the savings game. How to make up for a savings shortfall. If you crunch the numbers but don't have enough saved in your 401k or IRA to make the $1,000 a month rule or any of the other rule of thumb calculations work for you, here are steps you can take to close the savings gap. Increase your savings rate every time you get a raise. Don't upsize your house or car. Make catch-up contributions. Add how much that is for 2025. Make this a priority. Any additional cash you receive could go into an investment account for a worthy cause. In other words, your future.
All right. Talking about these retirement plans and how you should be socking money away just reminds me of the buddy of mine that has chosen the lifestyle of YOLO. You only live once, and you assume you're going to die at a young age because your parents did. And it's sad to watch people go through this that haven't properly saved, and they want their retirement years to be full of travel and fun, but they have no money to go do anything on. So you really need to think about your retirement plans, and you need to take an active approach to getting into an investment program. So whether you create it yourself or whether it's through your employer.
Agreed.
Okay.
Agreed. It's a little bit reckless to make assumptions about not living a long time, or because it can sting you.
It can sting you
on the back end.
Yep.
It can bite you. My biggest concern for employees is that the plan sponsors do not meet with the participants anymore and explain how much they should be saving and how to invest their money. If you need help with this, come see us and bring your plan information in the financial form, and we can send it to you. We can look at your numbers and how much you're investing and run a projection of where you'll be at retirement. The appointment is free of charge.
Yep. All right. Of course, if you follow Elon Musk's way of thinking, you could be out of the woods with regards to saving for retirement. Musk says saving for retirement will be irrelevant in the next 20 years. He has predicted that artificial intelligence would help create an abundance of resources for everyone. He says people would have whatever stuff they wanted and access to superb health care and education. He says that even though saving for retirement has been the cornerstone of personal finance for well over a century, he believes it could soon become pointless.
Elon, the world's richest man whose net worth exceeds $600 billion, described a future where advances in AI, energy, and robotics supercharge productivity, creating an abundance of resources that would allow everyone to be granted a universal high income, and people can do whatever stuff they want. That would mean better medical care that anyone has today available for everyone within 5 years. No scarcity of goods and services. You can learn anything you want about anything for free. However, the serial entrepreneur warned of a bumpy transition to this utopian world, marked by a jarring change and social unrest. He also flagged a potential loss of purpose.
Musk questioned his assertion, asking the $1 million question. If you actually get all the stuff you want, is that actually the future you want? Because it means that your job doesn't matter. As you're probably aware, Musk's companies are developing self-driving cars, humanoid robots, brain-computer interfaces, AI assistants, and other innovations as he paves his way to becoming the first trillionaire in history. Despite his track record, Musk's latest prediction clashes hard with the reality faced by many Americans. Years of stubborn inflation, elevated interest rates, and anemic wage growth have created an affordability crisis. Millions of people feel priced out of getting a college degree, accessing quality health care, owning a home, or even having kids. A comfortable retirement also feels out of reach, with surveys showing the majority of Americans aren't saving nearly enough.
Against that backdrop, Musk's blue sky vision of an abundant future may seem like wishful thinking or even dangerous advice if it leads people to stop saving. But if the world doesn't change as he expects, it would leave a lot of people short in retirement. So be careful with the advice you take. Stick to what works. Best to be prepared than not.
Yep. And I have a question. If everyone needs for nothing and we all have more than we need thanks to AI, does that mean crime will plummet as well? No more robberies, no more bankruptcies, no more of the bad stuff? But someone is going to need to work, right? Septic tanks don't fix themselves, and someone will need to deliver babies and change diapers. And not everything can be done by a robot. However, Sherry says that she kind of wishes she had a robot to deliver her babies when we were in Torrejon, Spain, because the doctor delivering it was hell on wheels.
Yeah.
So
I don't really know what to make of all of it. On one hand, you hear people who are scared to death about what the future looks like because of AI. On the other hand, you hear about how it has made work for people, and we can attest to this. Work for people and businesses incredibly efficient. Mentally, I just default to humans have always evolved and found a way, and this time will be no different. That's what I have to do to keep it,
I don't disagree with that.
Yeah.
I personally would not count on AI altering daily life to the extent that Elon Musk had described. I think that in many ways it will greatly increase efficiency and reduce the amount of work that is needed to sustain industries, but there will still be people needed, like human jobs, even in a perfect scenario. So if everyone is just on autopilot, just living life retired, who's going to be doing the jobs that humans need to do? What would be the incentive to continue to work when everyone else is just lounging around?
Right.
I guess we would just have to see when it comes to that, but I don't imagine that people would wake up every morning to go do a human job when they know everyone else is just
Getting by without it.
Yeah.
The thing is, and Musk alluded to it, that you're going to need a sense of purpose. So what that purpose is and how it's going to change and evolve over time is, I guess, just yet to be determined.
Right.
Just like a lot of AI uses.
For sure.
So, all right. Here's our weekly scam alert. If you get a voicemail from 404-675-3202, it's a scam. Check that you don't have unusual in your Adobe account. This last month, our office received numerous calls from this number, and I've received numerous emails on which, on the surface, appeared to be an Adobe representative. But something seemed off about the messages and the frequency of the calls. So I've Googled the phone number and was directed to the real Adobe site, where I learned that this number is associated with a known scam artist. And the really weird part of the entire event was that I do really need the consolidated licenses that Adobe has. And they, our entire office needs to be, have it installed and updated. It's just ironic that this guy was calling at the same time. So, but before you jump into a conversation with any caller, do a little research to protect yourself.
And something just to also add on the scam alert side, if you had Verizon and you lost reception, Verizon was talking about giving a $20 credit, but that is through their app. Do not click any text links that are offering that $20 because that's not Verizon.
That's a good tip.
They talked about it in the Verizon app,
Okay.
not a text message, not an email, in the app.
That's good information.
And Trump calls for a 10% cap on credit card rates in his latest appeal to affordability concerns, saying that American public is being ripped off in a Truth Social post. Trump called for the cap to come into effect January 20th, the one-year anniversary of his return to the White House, but he did not specify how a cap might happen, including whether he was calling for a voluntary participation from credit card companies or looking for government mechanisms to enforce the proposal.
In his post, Trump cited, in quotations in all capital letters, affordability as a rationale for the temporary cap, which he also proposed on the campaign trail in September of 24. The cost of living issue has become a source of increasing frustration for many Americans and a political liability for Trump and Republicans. Years of accumulated inflation have heaped on price pressures, and Trump blamed his predecessor, former President Joe Biden, for high credit card rates. But supporting caps on credit card rates represents something of an about-face for Trump, whose administration last year ditched an $8 credit card fee limit imposed by the Biden administration. The Consumer Financial Protection Bureau at the time estimated that the Biden administration's action would save families more than $10 billion a year by cutting fees from an average of $32.
Yep, and in 2024, a federal judge initially blocked that effort, and the Trump administration last year joined sides with the banks that had sued to stop the rule's enactment. The banking industry warned Friday night that Trump's proposal would hurt consumers and small businesses. The Bank Policy Institute, American Bankers Association, the Consumer Bankers Association, and Financial Services Forum, and the Independent Community Bankers of America issued a joint statement outlining the negative consequences. They say that while they share the president's goal of helping Americans access more affordable credit, they point to evidence that shows a 10% interest rate cap would reduce credit availability and be devastating for millions of American families and small business owners who rely on and value their credit cards. The very consumers that this proposal intends to help, and that if enacted, the cap would only drive consumers towards less regulated and more costly alternatives. And I would add, probably more risky.
Yeah. Credit card interest rates represent a significant portion of financial institutions' revenue. Capping those rates could backfire, resulting in significantly stricter lending standards and making credit unavailable to lower-income people or those with lower credit scores. That could exacerbate the so-called K-shaped economy in which America's wealth gap has widened. And if you're wondering what a K-shaped economy is, it's a post-downturn recovery where different groups or sectors diverge. One line of the K shoots supporting the wealthy, tech, and luxury as examples, while the other slants down or stagnates. The lower leg of the K represents lower income, hospitality, and struggling businesses. The effects worsen it worsens the widening of the financial inequality.
Yep, and while many wealthier Americans have enjoyed years of double-digit stock market gains, advancing home prices and rising wages, those earnings less have been squeezed by the combination of higher prices, debt, and slowing job market. Trump's credit card announcement came with other announcements issued on social media to try to convince Americans that he is making headway on the issue. On Thursday, for example, he posted about ordering his representatives to buy mortgage bonds to try to lower some home costs. Later, he wrote about banning institutional investors from snapping up single-family homes. Trump has his work cut out for him to persuade Americans that he is making headway on affordability. In CNN's most recent poll on the economy, 61% of Americans said Trump policies have worsened economic conditions in the country. This week, the New York Fed reported Americans' expectations that they'll find a job fell to an all-time low.
Just 198,000 Americans filed jobless claims last week, fewer than expected as layoffs remain low despite growing concern about a weakening job market. U.S. filings for jobless aid for the week ending January 10th fell by 9,000 to 198,000, down from 207,000 the previous week. The figure was significantly less than the 215,000 that analysts expected. Applications for unemployment benefits are viewed as a proxy for layoffs and are close to a real-time indicator of the health of the job market. Last week, the government reported that hiring remained sluggish in December, capping a year of weak employment gains that have frustrated job seekers even though layoffs and unemployment remain low. Employers added just 50,000 jobs last month, nearly unchanged from a downwardly revised figure of 56,000 in November. The unemployment rate slipped to 4.4%, its first decline since June.
Yep, and the Labor Department reported that businesses posted fewer jobs in November than the previous month, a sign that employers aren't ramping up hiring even as growth has picked up. Business and government agencies posted 7.1 million open jobs at the end of November, down from 7.4 million just in October. Layoffs also dropped as companies seemed to be retaining workers even as they are reluctant to add staff, a trend economists refer to as low hire, low fire. And recent government data has revealed a labor market in which hiring has clearly lost momentum, hobbled by the uncertainty raised by tariffs and the lingering effects of high interest rates. The Fed engineered in 2022 and 2023 to rein in a spike of pandemic-induced inflation.
In an attempt to stabilize a softening labor market, the Federal Reserve last month trimmed its benchmark lending rate by a quarter point, its third straight cut. Fed Chair Jerome Powell said members of the committee are increasingly concerned that the job market is even weaker than it appears. Powell suggested that the recent job figures could be revised lower by as much as 60,000, which could mean employers have actually been shedding an average of 25,000 jobs a month since the spring, when the Trump administration rolled out its sweeping import taxes. Companies that have recently announced job cuts include UPS, General Motors, Amazon, and Verizon. Thursday's report from the Labor Department also said that the 4-week average of jobless claims, which evens out some of the week-to-week volatility, fell by 6,500 to 205,000. The total number of Americans filing for jobless benefits for the previous week ending January 3rd declined by 19,000 to 1.88 million, according to the government. This Hyundai Motor Group unveiled their AI robotics strategy under the theme Parenting Human Progress. Partnering Human Progress. For Hyundai Motor Company and the automotive business, their robotic strategy is designed to help them build better vehicles while creating safer, more rewarding work for our team members. The Boston Dynamics humanoid robot we unveiled represents a breakthrough in industrial robotics. With 56 degrees of freedom, the human scale hand with tactile sensing and the ability to lift 110 pounds, Atlas will help us deliver beautiful design vehicles with exceptional quality. Hyundai says their robots don't compete with humans, they compete for humans.
Yeah, and they call this the human-centered automation. It means deploying robots to handle tasks that are repetitive, physically demanding, or potentially dangerous so team members can focus on higher value work that requires human judgment, creativity, and oversight. Lifting heavy components, working in extreme temperatures, and performing the same motion thousands of times per shift can take a physical toll on workers over time. By having Atlas and other robotic systems handle this work, they can reduce injuries, improve quality of life, and create a better working condition for the humans.
At the same time, Hyundai is creating entirely new categories of high-skilled jobs. Their investments in workforce development through partnerships with leading universities are preparing workers for roles such as robotic technicians, process engineers, and quality specialists. These are positions with great pay, job stability, and long-term career growth. In Georgia alone, Hyundai employs 8,500 direct jobs at Hyundai Motor Group Meta plant, with an estimated 40,000 indirect jobs in the region. Hyundai has spent $26 billion in the United States from 2025 to 2028, is expected to create 25,000 additional jobs and generate more than 100,000 direct and indirect employment opportunities. The future of manufacturing isn't human versus robot, it's humans and robots, working side by side, each doing what they do best.
A spokesperson with Hyundai said that together with the partners at Boston Dynamics, Google, DeepMind, and NVIDIA, they're building the future of mobility, one where technology serves humanity, not the other way around. It seems like a great time to be with Hyundai.
Sure it really does. I didn't realize how big Hyundai had become in Georgia.
Yeah.
Yep. All right. With the start of the new year, many people will receive their first credit card statement of the year in just a few days. And according to NerdWallet, nearly 75% of holiday shoppers used their credit cards for at least part of their gift shopping this past holiday season. Unless they shop early, Christmas expenditures will be on the next statement. And starting off the new year, paying off debt should be a top priority. Unfortunately, many will stretch those payments out longer than they should and end up paying about 20% more on their purchases due to the high credit card interest rates.
According to YouGov.com, that's UYOUGov.com, 21% of Americans resolved to save more money in 2026. Paying off the high interest credit card debt is an easy place to start. That can save you hundreds of dollars in interest depending on the amount you purchased on credit. But before you jump into saving and bill reduction mode, we would encourage you to develop a plan of action. Start by setting goals. Setting realistic goals is one of the best ways to remain motivated and improve your chance of success. The next step is to track expenses. This can be an eye-opening exercise and may reveal easy ways you can save money. And the money saved can be directed at credit card bills or build an emergency savings account.
After you've tracked your spending for 30 days, you need to create a budget. There are many ways to create a budget, such as the 50-30-20 budgeting method, where 50% of your after-tax money goes to necessities, 30% goes to discretionary spending, such as wants versus needs, and 20% goes into your savings or paying off debt. If you're living paycheck to paycheck, you should consider using some of your 30% used for discretionary spending to pay down your debt. You could also try a zero-based budget, which is a spending plan where you assign every dollar you make to a category so that you have planned expenses, including your savings goals, which are equal to your income. While it can be a strong way to reel in spending and prioritize saving, it can also be overwhelming or hard to stick to. You need to pick a process that works for you.
Yep, and as we said at the beginning of the show regarding the best financial advice, automate your savings plan. If you're employed and have access to a 401k plan, utilize that to capture the savings automatically. Since 401k plans are taken from your paycheck pre-tax, you don't miss as much as taking it from your after-tax funds. And if the employer matches your contribution, that's free money. Take advantage of it.
Yep. And it is a good time of year to review and cancel unused subscriptions. You can look at generic versus name brand foods and clothing, clip coupons, cut back on dining out. There are many more ways to save money. But the best way to save money is to shut down the impulse spending and pause purchasing anything, especially if you need to pay down your credit cards. And one last word on this topic. Another good way to save money is to maintain a good credit score. Good credit can help you qualify for lower interest rates on credit cards and loans, and that's going to reduce your borrowing cost. You can check your credit score and credit report for free and see where you stand. If your credit report isn't where you want it, paying down debt, keeping your credit card utilization low, and paying your bills on time can help improve it, which could make it easier for you to reach your savings goals.
Yep. And one thing I think I've mentioned before, it's very easy to do on most of these credit card apps nowadays, is that you can just get on the app and request a credit increase. And
Yes.
sometimes they'll approve you right on the spot. And so if you have a higher credit limit, then your credit utilization automatically is lower, proportionally speaking. So it's a good way to raise your credit score if you get approved, especially immediately.
But, there are just so many ways that people can save money. But, they've got to get the bills under control first. Without getting the bills under control, the savings and the like your emergency funds and your retirement plans really are going to come up short every time.
For sure. And I guess I should, sorry, go ahead.
No, go ahead.
I guess I should, I'll add to that. Don't increase your credit limit and immediately spend up,
That's right. Yeah.
Keep your credit where it is, get the higher limit, lower your utilization, and you will be in a better spot for it.
Yep.
So do we have time for this one? Or
We don't. We're down to about 1 minute.
Okay. Well, the gist of this next one is that 2025 home sales struck a 30-year low because of high prices and mortgage rates. I'll touch 1 minute. Okay. Well, I don't know if we can touch on any of this. And we've talked about homes a lot anyway.
Actually, we've got a little bit more time.
Oh,
Sorry.
we do? Okay.
Sorry.
All right. So the housing
clock was
market
wrong.
slump dragged into its fourth year in 2025 as sales remained stuck at a 30-year low with rising home prices and elevated mortgage rates, as I mentioned a minute ago. Sales of previously occupied U.S. homes totaled $4.06 million last year, essentially flat versus 2024 when sales sank to the lowest level since 1995. Without rounding the figures, sales last year were slightly lower than 2024. According to the NAR, the median national home price for 2025 rose 1.7% to $414,000. No wonder nobody can afford to be in a house.
That's right.
Sales have been stuck close to a $4 million annual pace now going back to 2023. That's well short of the 5.2 million annual pace that's been historically the norm.
And why don't you just finish it up because we got like 40 seconds.
Okay. The housing market has been in a sales slump dating back to 2022 when rates began to climb and stayed high. The combination of higher mortgage rates, years of skyrocketing home prices, and a chronic shortage of homes nationally following more than a decade of below average home construction have left many aspiring homeowners priced out of the market.
Yep.
In recent weeks, the Trump admin has floated proposals aimed at easing the affordability crisis. We've talked about it. 50-year mortgages, I wouldn't encourage it. A ban on large investors buying houses, I like that. and a bid to lower mortgage rates by spending $200 billion to buy back mortgages. Yet some economists believe the proposals would only put a dent, or would barely even put a dent in with its impact. The average rate on a 30-year mortgage was around 7% a year ago, remained elevated for much of the year, and then, as Randy said at the beginning of the show, about 6% now.
Yep.
That's all the time we got, folks. Have a great weekend, everybody.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.